Good evening and welcome to our Spring Term Money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I am Damian Pudner, Director of the IIMR, and today we are delighted to be hosting Gabriel Stein. Gabriel is an independent macroeconomic commentator and forecaster. In 1980, he graduated from Stockholm School of Economics. In 1981, he worked at the Israeli Ministry of Finance International Relations Department. From 1982 to 1990, he ran Stein Brothers, a public affairs and economics research consultancy, first in Stockholm and from 1990 in London. From 1991 to 2012, Gabriel was chief international economist of Lombard Street Research, where he helped set up the company's world service. During this time, he wrote and commented on all major world economies. From 2012 to 2014, he ran his own macroeconomic forecasting consultancy, Stein Brothers UK. In 2014, Stein Brothers UK was acquired by Oxford Economics, and he became their Director, Asset Management Services. From October 2016 to August 2017, he was Managing Director, Developed Markets Research at Forecast RGE. Gabriel has guest lectured on numerous universities in the United Kingdom and abroad. From 2019 to 2021, he was Associate Lecturer at St. Mary's University, Twickenham, where he taught a course on EU politics and policy. Since 2021, he has been a visiting lecturer at the University of Buckingham, teaching principles of macroeconomics and macroeconomic theory, as well as central banking, history, strategy, and operations, the latter at postgraduate master level. Since 2023, he also teaches money and banking at the University of Languages and International Studies, Vietnam National University in Hanoi. He is a member of the Academic Advisory Council of the IIMR, for which we are very grateful. Gabriel has an MA in military history and a PhD in economic history, both from the University of Buckingham. He has also written 4 historical novels. And with that, I'll hand over to you, Gabriel.
Well, thank you very much, Damian. I'm always amazed when I hear someone introducing me and I think, wow, is that supposed to be me? Who is it really? Also, thank you to the IIMR, which I think is a really amazing institute, which certainly fills a sorely needed gap in the academic world. Okay, when £1 is not £1. So human beings instinctively, I think, like order and certainty, and I think that's particularly true in financial and monetary matters. I'm not talking about the uncertainty of a risk-reward judgment. I'm talking about values and standards. When it comes to money, we want to believe that £1 equals £1, what the Bank for International Settlements calls the singleness of money. A £10 banknote issued by the Bank of Scotland should be worth the same as a £10 banknote issued by the Bank of England or by Clydesdale Bank. A $100 Hong Kong note issued by the Bank of China should be worth the same as a $100 Hong Kong note issued by HSBC, and so on. And I think that's true today. I think it's been true historically. And in fact, we've seen throughout history how monarchs have repeatedly attempted to standardize weights and measures, including coinage. And we've also seen that if, as often happened historically, the coinage became confused, there was a call for re-standardization. Similarly, when Islam and Judaism ban the use of interest or usury, they do so in terms that implicitly mean that one measure should always be that measure. You lent or invested a certain sum, you should get back that identical sum that was lent or invested. And there's a nice quote from the 1743 Swedish Law of Commerce that says, quote, "What is advanced shall on the appointed day to the creditor or his representative or to whoever holds his right with the same kind evenly and fully be repaid. But what if it ain't so? What if the value of £1 or $1 or what have you fluctuated, not only because we have a general inflation or deflation, but possibly even on a day-to-day basis? It sounds fanciful, it's not impossible. So I have recently finished a PhD in economics history at the University of Buckingham. My thesis looks at a period in Swedish history which I believe is unique, not only in Sweden, but globally. From 1789 to 1803, the government issued banknotes through two institutions. One was through the Bank of the Estates, today's Riksbank, the Central Bank of Sweden. The other was the newly created National Debt Office. The two kinds of banknotes were in the same currency, riksdaler, dollar if you want, and they were occasionally in the same denomination. The only difference was that the bank currency was convertible into silver and the debt office notes were not. And the debt office notes depreciated, and by 1803, one bank dollar was worth 1.5 debt office dollars. Now, as I said, this is an almost certainly unique episode. There have been plenty of examples of parallel currencies. There have been plenty of examples of multiple issuers of banknotes. I referred earlier to Scotland and to Hong Kong. And there have even been examples of issuers, multiple issuers of banknotes where their value diverged, for instance, in free banking eras in the United States. What makes the Swedish episode unique is that both kinds of banknotes were in the same currency, in some cases identical denominations, and that both were issued by the state, and yet their values diverged. However, because this was such a unique episode, that was also a reason why it seemed to be a once-off. Surely something as strange as that could never happen again. I'm not going to spend more time on that. I could obviously bore for England on this topic, but what is relevant here is that where about 5 or 10 years ago, this would have been a minor, if fascinating, curiosity of monetary history, in my opinion, it has become relevant again. And that's because of the plans of many central banks to issue what they call central bank digital currencies, CBDCs, electronic versions of their existing currency. By the way, it's a really, I think it's a really bad term. Central bank digital currencies already exist. Bank deposits with the central banks are CBDCs, but it is the accepted term, so I have to use it. I think it's safe to say that central banks envisage these as a complement to, not as a substitute for current money. By the way, I may use, when I talk, I may refer to something I call legacy currency. That's my own term to differentiate between CBDCs and non-CBDCs. Legacy currency refers to notes and coins and to accounts in private banks, in commercial banks. But like I said, central banks just see this as another version, a complement. But again, what if it ain't so? Now, why central banks want to issue CBDCs varies. It depends on the central bank. There are a number of reasons. One of the more compelling one, in my opinion, is a point made by the then Deputy Governor of the Bank of Sweden, Cecilia Skingsley, who is now in charge of the BIS's innovation program, particularly when it comes to CBDCs. when she said that the Bank of Sweden expects that the last banknote will be phased out of circulation in Sweden in 2028, which is not very far to go. That, by the way, is unlikely to happen, but cash use is diminishing very rapidly in Sweden. There are many places where you could go where people will ask if you try to pay cash, well, what's that? We don't take that kind of thing. And according to Cecilia and what the Riksbank thinks is that the public needs access to central bank money. That's not entirely certain, but that's what they feel, and so they want to make sure that there is an electronic version. There are other reasons why central banks want to do this. Central banks also discuss which format a CBDC would take. Would the general public suddenly be allowed to have accounts with a central bank? Would they have an electronic wallet? Would there be tokens and so on? This is all important, but what seems to be discussed very little, as far as I can see and as far as I've found, is the possibility of a divergence in value between a CBDC and legacy currency. In other words, £1 bracket CBDC, close bracket, may not be the same as, to coin a phrase, the pound in your pocket. However, there are reasons to believe that this could happen. Now, what if it does, and how could it happen? Well, actually, this is an asymmetric problem, first of all. Very simple, CBDC versus legacy currency. We can have unintentional and unintentional, and the CBDC can appreciate or depreciate versus the legacy currency. Note the green and red color on the unintentional side. They show essentially no problem and big problem. Okay, so let's look first at the thought of an intentional divergence. Why would a central bank wish to let the value of its digital currency diverge from legacy currency? This is a topic that has a proposal that has been raised by a number of academics, not very many, but significant still. The starting point for this is the environment of the pre-pandemic 2010s. In many countries, in spite of policy interest rates at ultra-low levels, or even in some cases negative, central banks failed to achieve their inflation targets from below. In other words, inflation was below target for a very, very long period of time. And there was concern that even if they managed to get back to inflation, central banks would regularly find their interest rates at or near the effective lower bound, whether at zero, which we know is no longer the case, or below zero, where we actually don't know where the lower bound is. And if interest rates are stuck at the effective lower bound, then monetary policy, at least in its traditional form, risks becoming ineffective. And concerns, fears were increased by research that showed that real interest rates have in fact been trending down for over the very, very long term, which means since about the 14th century. And if you extrapolate that, then real interest rates will eventually trend down into negative territory, and then you're really in trouble. I'm not sure that this argument is entirely correct. It certainly is true that traditional monetary policy, where you set a policy interest rate, may be less effective at the effective lower bound. But that does not obviously mean that central banks are unable to conduct policy. We know there are other options available, notably, of course, quantitative easing and quantitative tightening, which can actually directly influence the amount of liquidity in the economy, and there are other options as well. Two papers that I looked at argue that the way to circumvent the ELB-related concern is to let the value of the central bank digital currency vary against the legacy currency. And the rationale behind this idea is that we have the situation, inflation is below target, interest rates are low, and in order to stimulate inflation, the central bank will have to push interest rates well below zero in order to stimulate the economy and get its inflation target. And of course, households and companies can always shift to cash, and cash doesn't lose its value. And so the proposal is that a central bank could counter this by managing the exchange rate between the CBDC and cash, so that cash, or bank accounts, of course, depreciates in value relative to the CBDC by an amount equivalent to the impact of the negative interest rates. And if that's the case, there is no point, obviously, in shifting to cash, and there are a lot of issues with shifting to cash anyway. And once you reach your inflation target, you can then let cash appreciate until it gets back to par with the CBDC again. This is not without its complications. For one thing, you have to rewrite contracts. You have to make sure that it's the CBDC that becomes the key numeraire in the economy. It can't be cash anymore. Contracts would have to be written so that if they're expressed in the electronic currency, they can't be repaid in depreciated cash. There's also a question, would retailers allow the diverging exchange rates to pass through to customers? If not, it means that the retailer, the seller, takes the exchange rate risk. Okay. If they do, it gives a situation where buyers can possibly arbitrage between the means of payments, and that would be confusing. And that's true even in a world where your smartphone app will always tell you what the latest exchange rate and which means of payment is preferable. More to the point, this policy would, it seems to me, only work if households and companies are convinced that parity will be restored on terms that don't favor cash. So it has to be credible that the period of negative interest rates will be limited. Because if it's not, then you can see a situation where if households and companies expect a prolonged or indefinite period of ever deeper negative interest rates, and this is coupled with the view that the monetary and fiscal authorities are will be unwilling to depreciate cash by as much. It also will be more difficult if the amount of cash in use has risen substantially. And you could then have a situation where the use of CBDCs diminishes substantially on the retail level, which leaves cash as more attractive, and cash therefore commands a premium, which would work counter to the aims of negative interest rates. And this would then necessitate even deeper interest rate cuts to achieve the inflation target. And ultimately, the central bank would lose control over the exchange rate between the two types of money. There's also another factor, which is if retailers protect consumers from the impact of the negative interest rates, of the depreciating cash, again, and cash becomes therefore more attractive relative to a CBDC with a deeply negative interest rate, might we not see an example of the reverse of Gresham's law operate, So Gresham's law, of course, is bad money drives out good, and the reverse is that good money drives out bad. Now, Gresham's law supposedly only works with fixed exchange rates. So if the exchange rate is floating, it's reversed. Now, here in theory, we're supposed to have a fixed exchange rate, even if it changes. But as we've seen throughout history, fixed exchange rates do have an unfortunate tendency to go unfixed if they don't reflect the fundamental needs of the economy, regardless of how committed the political and monetary authorities are. Cash could also be at a premium if households and companies believe that their CBDC holdings may be reduced for whatever reason the state chooses. Negative interest rates, of course, but how about some form of tax or expropriation for whatever reason, fiscal policy, in other words. So there is a risk that a central bank, by allowing an exchange rate to develop between a CBDC and legacy currency, could potentially lose control over the process. And that would certainly complicate its ability to conduct monetary policy. Now, that would at least be a deliberate policy. And so hopefully it could be undone before you lose control. But what about unintended divergence? So if we assume that no central bank is going to act on this academic idea and intentionally let the value of its CBDC diverge from legacy currency, could it happen anyway? We have two options. The CBDC can appreciate or depreciate. Well, if it appreciates, it's very easy for the central bank to deal with, because all they need to say is, we will always swap at par. But what if it's the CBDC that depreciates relative to the legacy currency? And why would this happen? Well, there are a number of possibilities. One, which is perhaps far-fetched, is where doubts arise about the solvency of the state, and therefore bank deposits are actually perceived to be safer than the CBDC, and they begin to command a premium. You could have a situation, for instance, if a lot of people have bank deposits in multinational banks and the national finances are in deep trouble. Think Greece in 2010 to 2012, if it had not been part of the euro area. This, by the way, is probably similar to what happened in 18th century Sweden, because my hypothesis there is that the exchange rate between the two types of banknotes was mainly driven by changes in the size of the government debt. But there are other possibilities. Perhaps something more possible is where access to the CBDC is limited. And that's, in fact, what a number of central banks intend to do. The ECB is clearly aiming at setting a limit on how much CBDC individuals can hold. The number they have talked about is 3,000 euros, which is not very much money. And in addition, only households in the euro area will be able to hold CBDCs. Companies will not. Not sure what happens when you pay a company with money from your CBDC account, but presumably it goes into a non-CBDC account. More complicated, what happens if you, say, sell your car and someone pays from their CBDC account? Are you then forced to transfer between your CBDC wallet token account into a bank account any excess? The Bank of England is also talking about a limit, a rather higher limit, between 10 and 20,000 pounds, at least so they say during the introductory period of the digital pound. Why would they have such limits? One reason is if everybody had instantaneous access to unlimited amounts of CBDC, there is a risk, a very palpable risk, I would say, look at Silicon Valley Bank, that deposits would flee commercial banks in a crisis. And of course, if banks suddenly find that the liability side of their balance sheet is rapidly shrinking, they have to shrink their assets as well, which means calling in their loans, and if prematurely, and if this happens on a sufficiently large scale, you could quickly see an economic collapse. And it would certainly at least severely constrain the ability of commercial banks to issue deposits, in other words, to grow the loan books and grow money supply. Although actually that could potentially be averted if the central bank guaranteed to replace lost deposits one for one, but there would then be other issues related to that. However, this idea of limiting access to the CBDCs is a radical break with current state of affairs. Anyone today who, for whatever reason, distrusts banks, distrusts other assets, can go completely liquid. There is no legal or regulatory limit to how much cash any person can hold, as far as I know, in any country. There may be some complications. You try to pay for a car using only cash, someone will probably say, where did you get that money from, and so on. But it's perfectly legal, it's perfectly feasible. But the proposals from the ECB and the Bank of England would, for the first time, I believe, impose a limit on how much of a particular central bank money any one agent can hold. And that's before we start looking at things like, well, what about in families? What about if, like me, you are a dual citizen and you hold CBDC accounts in different countries? None of this, I believe, has been made clear. And it's very possible that this could lead to a scarcity premium on CBDCs. Another possibility is that legacy currency would acquire a usefulness premium. In other words, if you can't hold more than a very limited amount in CBDC format, its use becomes less attractive. Certainly so for large transactions, like say buying a house, buying a car, going on an expensive holiday, whatever, where you would very quickly exceed the limit. So why would you bother holding the CBDC in the first place? Very conceivably and hypothetically, it's possible to see a situation where the use of a CBDC is also restricted. Is it entirely unlikely that we could see a situation where a CBDC cannot be used to pay for, let us say, gambling, prostitution, alcohol, tobacco? Today, such restrictions seem very unlikely, of course. Central banks in most developed and developing economies, they're independent, they're supposed to concentrate inflation, but we have also seen growing calls, notably in the wake of the 2010s and central banks' failures to achieve their inflation target, and certainly in the wake of the COVID pandemic, calls to curtail central bank independence, as well as calls to broaden central bank mandates. I need only mention climate change, for instance. The reason this strange situation arose in Sweden back in the 1780s was because the king wanted to borrow money from the Bank of Sweden for use in contravention of the Swedish constitution. And the bank stood up to him and said, forget about it. Would any central bank today be prepared to show the same independence in the face of demands to implement government policies unrelated to its mandate, particularly if it's if the government is aiming to help combat a perceived existential threat, be it for the nation or the world? It certainly hasn't been put to the test, and I'm not sure what the answer would be. There is another factor to consider. One of the advantages of cash is, of course, its anonymity. With electronic currency, every transaction can be traced. We saw this after the Russian invasion of Ukraine, when Russian attempts to circumvent financial sanctions by using Bitcoin and other cryptocurrencies merely turned out to leave a clear trail for sanction enforcers to follow. The ECB has said that there is no way they're going to trace CBDC transactions. I don't think the Bank of Sweden or the Bank of England or the Fed would do it either. But if you lived in China, would you really believe that they are not going to keep records of your electronic transactions, particularly since they already do? And this isn't even entirely alien to Western writers. The late Swedish economist Ingmar Stahl, writing in 1979, and the American economist Kenneth Rogoff in 2016, both outline the benefits as they see them, of a cashless society. Now, Ingmar Stahl's vision was actually a dystopic satire, but Rogoff is quite serious. So he points out most cash, in particular large denomination banknotes, is primarily used in the underground economy and for illegal activities. And therefore, he thinks, we should phase out at least large denomination bills, but ultimately we should phase out cash completely. And this would, he thinks, help combat tax evasion, crime, and corruption. And of course, both Stahl's satire and Rogoff's serious proposal imply that transactions would have to be monitored and traced. And we can see a sort of parallel in the UK going on at the moment, where the government wants to be able to break the encryption of direct messaging in social media, of course, as ever, telling us that if you're innocent, you have nothing to fear. And you should be able to, the government should be able to read messages. My point here is that in the context, in a society where all transactions can be monitored, it is very possible that anonymous and untraceable cash, and even Rogoff expects some cash to remain, would again command a premium over traceable electronic money. But even absent that, the idea of limits on CBDC holdings, possible policy, and so on, could lead to a situation very similar to what Sweden experienced in the 1790s. One currency circulating in two forms, one of them not as useful as the other. And in that case, the less useful type of money will probably depreciate, the more so if there are specific transactions where it cannot be used. And so once again, monetary authorities could find themselves in a situation where their ability to conduct monetary policy is impaired. And if there's no single cause between the fluctuations in the exchange rate between the two parallel types of money, CBDC and legacy, it will be even more difficult for the authorities to do something about it. And then you run up against the problems, the reasons for having a holding limit in the first place. Unfortunately, I don't have a solution. Partly, the situation may not develop, but I think the possibility is certainly there. Partly because there may simply be no solution. So if central banks are hell-bent on introducing CBDCs, and this can be discussed, Kevin Dowd has shown, I think, in the latest issue of Economic Affairs, that so far most examples of CBDCs have been a miserable failure. But if they really want to do it, the best option is probably to make CBDCs as much as possible identical in scope and structure to cash and bank deposits. And yes, there are risks with this, notably the danger that a bank in trouble would suddenly and rapidly lose its deposits. It may mean a change in how the financial system operates. That's well beyond what I'm talking about now. But it seems to me that this is another issue, yet another issue that central bank needs to consider in what seems to be at the moment a relentless march towards a more digital future. And I really don't think they have considered this very much at all. At the moment, my impression of CBDCs is that they are an answer very much in search of a question. The problem that I've highlighted, I think, is a question very much in search of an answer, which is, what do you do if this not entirely unlikely future materializes? I don't know. Do central banks know? I fear not.
And with that, I wish you all a good afternoon from London. Thank you.
Thank you very much.